Hi everyone, welcome to the channel. In this video, we're going to answer a very common beginner question. What is an ETF, and why do so many investors talk about them? The basic idea of an ETF. ETF stands for Exchange Traded Fund. Let's break that down. Fund means a basket of many investments put together in one product. Exchange traded means you can buy and sell this product on a stock exchange, just like a stock. So an ETF is a basket of investments that trades on the stock market. When you buy one share of an ETF, you are buying a small piece of everything inside that basket. Imagine you go to a supermarket. Instead of picking 50 different items one by one, you grab one big basket that already has a mix of food inside. An ETF works in a similar way for your investments. What can be inside an ETF? Inside an ETF, there can be many different types of assets. Stocks, shares of companies. Bonds, loans to governments or companies. Sometimes commodities, like gold, or a mix of different things. The most common ETFs for beginners are stock index ETFs. They try to copy the performance of an index, like the S&P 500 or a world stock index. If the index goes up, the ETF usually goes up. If the index goes down, the ETF usually goes down too. How does an ETF work in practice? Behind every ETF, there is a provider, like an investment company. This company creates the ETF and decides what index or strategy it will follow. They buy the assets, for example, all the stocks in that index, and put them into the fund. You don't buy those stocks one by one. Instead, you buy shares of the ETF through your broker. The price of one ETF share moves up and down depending on the value of the assets inside the basket. You don't directly own each individual stock, but through the ETF, you get exposure to all of them with one trade. ETF versus single stock. If you buy a single stock, all your money in that trade depends on one company. If that company does very well, you can earn a lot. If it has problems, your investment can fall a lot too. With an ETF, your money is spread across many companies or assets at once. This is called diversification. Diversification does not remove risk, but it can reduce the impact of one company failing. For a beginner, it is often easier to buy one broad ETF than to research and pick dozens of individual stocks alone. Main advantages of ETFs. Let's talk about why so many people like ETFs. 1. Diversification. One ETF can hold tens, hundreds, or even thousands of different securities. With a single purchase, you spread your risk across many companies, sectors, or countries. 2. Usually low cost. Many ETFs have relatively low annual fees compared to traditional mutual funds. Because they often just track an index instead of paying a manager to pick stocks, they can keep costs down. Lower fees mean more of your money stays invested over the long term. 3. Easy to buy and sell. You can trade ETFs on the stock exchange during market hours, just like a stock. You see a live price and can buy or sell when you want, through your broker app or platform. 4. Transparency. Most ETFs regularly publish what they hold. You can easily check which companies or assets are inside your ETF. 6. Risks and what to be careful about. ETFs are not magic and not risk-free. Market risk. If the market or index your ETF tracks goes down, your ETF will likely go down as well. Diversification cannot protect you from a general market crash. Wrong ETF choice. Some ETFs are very broad and simple. Others are narrow, very specific, or use leverage and complex strategies. These complex products can be much riskier and are usually not good for beginners. Fees and liquidity. Most big ETFs are cheap and easy to trade, but some small or exotic ETFs can have higher fees or low trading volume, which can make buying and selling more expensive. Always read the basic information. What index does it track? What is the annual fee? What is inside the ETF? Imagine you want to invest in the 500 biggest companies in the US. You could try to buy 500 different stocks, which would be complicated and expensive. Or you could buy one ETF that tracks the S&P 500 index. With one purchase, you get a tiny piece of all 500 companies. When the overall market of those companies grows, the ETF value can grow too. When the market falls, the ETF usually falls as well. This is the power of ETFs for long-term investing. Simple, diversified exposure to a big part of the market. So, what is an ETF in simple words? It is a basket of investments. You trade it on the stock exchange like a stock. It often follows an index and gives you instant diversification. It can be low cost and transparent, but it still has risks. If you found this helpful, give the video a like and subscribe to the channel.